So let me read my disclaimer because I always have to do that, unfortunately. Please note that investing in real estate and other financial instruments involves a high degree of risk and potential loss of some or all of your principal. This presentation is not an offer to buy or sell or a solicitation of an offer to buy or sell any interest, securities, or to otherwise participate in any investment or trading strategy. As such, offers can only be made through our definitive legal documents, including the operating agreement, private placement memorandum, and other important subscription documents, which include important information, most importantly about risk of loss and other risk factors. Finally, note that nothing that I'm going to talk about tonight should ever be interpreted as investment advice, tax advice, financial advice, or legal advice. Although I'm a CPA by background, my license is inactive and I'm technically not allowed to give you tax advice. Before making any investment decision, you have to make sure that you consult your own financial advisor. Please make sure that you do that. All right. So tonight, well, before I get into tonight's headlines, I do want to, there's a lot of new people on this call, and I'll be brief, but I'm coming to you from Orlando because it actually has really interesting meaning for this particular webinar. Because 25 years ago, I got into this business primarily because of my daughter. It was one night in the middle of the night, I was trying to, I was doing her night feeding. She was an infant, and I was at Deloitte at the time as a CPA, and it was my time with her. It was during the corporate busy season, right after she was born. So my nighttime 3 a.m. feeding was my father-daughter time, and I loved it. It was cool. Problem was, after a while, I started to realize, wait a minute, this isn't cool. This is 3 o'clock in the morning, and this is my daughter and my time together. That is not how I wanted to live my life. I started thinking about things like, how am I going to put these kids through school? Remember, 25 years ago, I was a lot younger. My family was very young, and everything was ahead of me, and I had a lot to figure out. You see, I thought I had it all figured out. I gone to school, got great grades, got a great job. I was working at Deloitte. Everything was supposed to be set. But here I was at 3 a.m. That was my quality time with my daughter. So I decided I had to make a change. So that's what got me into real estate. I had to figure out how to make a change. So over the next 3 years, I bought 3 apartment buildings, very small apartment buildings, less than 30 units each. But what happened at the end of that 3-year period is what really changed everything for me. And that was I sold those deals. All 3 happened to be at the same time. And I made $500,000. And that just blew my mind. Before I was trying to figure out how was I going to do this with my family, right? How was I going to get to spend some time with my family and do the things that I wanted to do? Well, here it is, 3 small apartment buildings on the side, and I had made more money on the side than I did working like a dog as a CPA at Deloitte. So I never looked back after that. I mean, I worked for Deloitte for a few more years, but I'm thrilled to say, fast forward 25 years, we've helped, I'll share with you tonight, hundreds of investors do exactly what I've done. And the reason this night has special meaning for me, and it relates specifically to the story I just told you, because I'm in Orlando. My daughter now lives in Lexington. She works for a private equity firm, and she's going to meet me here. She's on a plane as we speak, and we're going to get to spend the weekend hanging out and doing father-daughter things, 25 plus years later. So it really is cool. I will tell you, the fact that I did make the change that I did in my life is the reason that I got to spend so much time with my family. We're in Orlando because growing up, my kids, we spent a lot of time at Disney, and she really still enjoys the resorts and going to Disney. So that's why we're here. All right, so let's dive right into it. Now that you understand why I'm here and why I'm on this laptop, and it probably doesn't look as pretty as it usually does, now you know. All right, so tonight, let's talk about a few things. We're going to talk about a lot of things. First of all, the 4 things I want to make sure we cover. Did the real estate market, has it bottomed out yet? Or is there more pain coming? People are thinking about this a lot. The banking crisis, is there going to be more banks to fill? And oddly enough, should we even care? That I'm going to talk about that because, when it was happening, I would have never made that statement. Of course we cared, but I would make it now. Predicting the Fed's next move. People don't know what the Fed's going to do next. Nobody does. They probably don't. But what does it mean? And what do I think is going to happen? We're going to talk about that. And then we always talk about, should you invest now or should you wait? And so that's what I want to make sure that we cover off on tonight. So, the point of this whole webinar is the real deal, right? I named this the real deal because nobody actually lifts the hood and lets you look inside and see what's really going on the ground. And that's what we're trying to do here tonight. So you're going to get some details that you probably won't get in a lot of these types of webinars. This is not a sales webinar, right? My goal here is to let you know what's going on so that you make good, informed investment decisions. So to date, we have invested in about $130 million worth of assets. We've raised about $35 million. Now, this has not been updated in the last couple of months, just because I'm not going to update it one or two, million at a time. We have not bought a new deal since the last webinar. We have a total of 240 plus or minus investors that have invested in our deals. I'm pretty proud of that. In 2022, we distributed just under $700,000. In 2023, our distribution goal is $2.5 million. We currently own or manage about 1,750 units. That's the real deal. Now, if you're in our last fund, and some of you are in our last fund, it deployed a total of $16.6 million between the fund and a side raise that we did. So I'll just give you an update on those three deals. 84 units in Tallahassee, Florida. We paid $10.8 million. I am over the moon excited to tell you that we have moved rents by just under $300 a unit, and we closed basically November 1st of 21. So it has not even been a year and a half. Maybe we're coming up on a year and a half. So that is incredible movement in rents. And on top of that, the property had never billed out and recovered water fee costs. And so our monthly revenue for water reimbursement is about $6,000. So all in, we're up about $32,000 a month on that in just a short amount of time. I couldn't be happier with that investment. The next deal, 234 units in Bradenton. This is the one we did the side raise on as well. So I know some of you here are in that side raise. We have moved rents so far by $181 a unit. So just do some math, 181 times 234 times 12. That shows you how much new cash flow we have generated in that property. That property continues to turn and do really well. We have thrown out at least half the people in the property, replaced them with considerably better residents, and our renovation project continues to go very well. We have so much demand for leasing there. We can't even keep up with it. It's really kind of crazy what's happening with Bradenton if you're not familiar with it. It is just a really fast growing part of Florida. The last deal that's in the fund, 55 units in Daytona. It's the smallest deal. We paid a little over $8 million. We have moved rents even in that little bitty property, $167 a unit. The reason we bought that property, it's in Daytona, but it's townhomes, and there's literally no other townhome properties in that entire area. So we have sort of the 100% market share in that unit type. People love to live in townhomes because it's the closest thing to having a single family house. They can go in their front door, out their back door. There's tons of green space. They don't have anybody living above them. It's a really, really popular floor plan that I love buying townhome properties. So that property continues to go really, really well. I think I said last quarter we distributed, well, no, I didn't. Last quarter we distributed about $300,000. Next quarter, we plan to distribute about 2.3 million. It might even be more than that. I'm not sure exactly what that number is going to be yet. But we're excited about our ability to make distributions in a market like this. Currently, our fund terms, right? So if you're not in the last fund, you might want to consider getting in our current fund. I would strongly encourage it for obvious reasons. When we do our deals, our same underwriting that we used in our last fund is what we're using in this fund. We're targeting an overall annual return of 15%. Now, part of that comes from the preferred return. Those are those cash distributions that we talk about. And then the balance of it, of the return, comes from when we sell the property. So basically, the way it works in our world, you get a 6% preferred return. So that means you get 6% first, and then after you get that, you get all your capital back. Then we split profits 80-20, with 80 going to you. One of the reasons that we were able to do that side raise with the Bradenton deal is everybody in our fund one had the first right of refusal on that side raise in Bradenton. And quite honestly, there was massive interest from our fund one investors. And so we had a little bit of extra that we could offer to some of the folks on this call. So that is a really important thing, because we try to offer those side raise opportunities at the same, the same metrics, right? The same preferred returns and all that. If we can do that, we try to do that. A minimum investment in our fund, just like last one, is $100,000, accredited investors only. We plan generally to hold a property 3 to 5 years. We can hold it longer if we need to, right? We're not going to sell with a gun to our head. We don't want to do that. So our target hold period is 3 to 5 years. And if you've seen any of our past deals or our track record, you'll know that that's pretty consistent with what we do. We like to go in, add our value, leave some for the next guy or gal, and then sell and return that money with the profit to you in a reasonable amount of time. We continue to target the same markets that we always have: Southeast, Southwest. We're primarily right now in Florida. We are trying to get into other markets. We are carefully doing our research right now to hopefully get a deal in additional growth markets. The bottom line for us, it's got to have a significant demand supply imbalance, obviously in favor of demand. So let me keep going here. Since our last multifamily, or since our last Real Deal update, so this is since last month, we've had another bank fail. But I don't know that anybody actually cared. I mean, it barely made headlines. The FDIC came in the night before, sold it to JP Morgan. JP Morgan, I think, opened it the next day. It's really kind of an interesting concept that we find that we see going on in the market right now. Now, I'm sure that the bond and equity holders, they cared, but the depositors just didn't care. And I'm pretty sure it's because the FDIC has basically told everybody they're gonna insure anything and all the deposits, no matter what. I'm sure that's why nobody cares, because it only affects the people that own the banks. All those new banks have found new owners. Any failed bank, there's nobody sitting in the FDIC still in receivership, so that certainly is good. I'm pretty sure, last I checked, the Federal Reserve still is allowing banks to borrow against their mortgage-backed securities and the treasuries that they're holding in their inventory, as if they were still valued as they were when they were bought. So if this is your first Real Deal webinar, you might not know what I'm talking about, but basically when rates rise, especially as they have, and you buy a bond, a mortgage-backed security in a U.S. Treasury, they are basically bonds. When the interest rates go up, prices of those bonds go down. So if you were to revalue those bonds, you would have massive losses. That's what sunk SVB, and that's what made people freak out and want to take their money out, because they sold, I think it was $20 billion or $18 billion worth of securities at a $2 billion loss. Well, the Federal Reserve said, look, you don't need to go out and get new capital banking system. You can borrow from us, and we will allow you to place those securities as collateral, and we will pretend like they didn't go down in value. So that's one of the things that the Fed is doing to make sure the banking system continues to be okay. I will tell you, a little bit frustrating, the interest rates continue to react on every single piece of little news that comes out there. We'll talk about this, but just in the last 5 to 7 days, the 5-7-year Treasury has moved like 25-30 basis points. And we'll talk about why in a minute. But so every little piece of news that really affects inflation or the economy, the interest rates are reacting to it, and it's much more volatile than it ever has been over history. So it just makes doing deals a little bit more challenging for us. It's just, part of the rules of the game. We just have to play it. But that continues to frustrate us. There have been times over the last several months where they've stabilized, and every time I think they're going to stabilize, they get a little crazy again. This is really good news here. Since our last real deal update, the CPI continues to trend down. I thought I would just give you an idea on this chart what's happened. So, last November, I could have gone back further. I'm not sure if pre or prior to November, it was more than 7.8, but 7.8 annual CPI, that's pretty high, and it's down to 4.9. So we are making progress. We're heading in the right direction. That's good. It's not worth 2 thumbs up, right? But it's at least worth 1. Until the Fed sees all these things happening and they get to their target rate, they've indicated that they're going to continue to put pressure on the economy to slow things down. What do we think is next? I think most people think the Fed is close to being done raising rates, but it's interesting. Over the last 5 to 7 days, I think there's been some uncertainty, creeping back into the market. I'm not sure if it's earnings that are coming in somewhat better than expected. I'm not sure if it's the labor market that is not softening. Believe it or not, the Fed wants people to lose their jobs. They want layoffs. They want to see the wage market, the labor market starting to suffer a little bit, because that will then stop people from spending. When people don't spend, prices just come down because demand is reduced. So we're going to see. I think the primary reason that the rates have moved over the last 5 to 7 days is because people are starting to get worried that maybe things are still more resilient, still stronger than the Fed wants them to be. And I think they're actually thinking there's a chance that we'll get another rate increase. So we'll see. I think that's what's going on here. I think most economists, the ones that I follow, really thought that the Fed would be done with the last rate increase of 25 basis points, but we'll see. I think the market's starting to second guess that.
And we have a question
Sure.
going off of this. Donna
Mhm.
asks, what is the status of your deal search? Are you seeing opportunities that are close to working, or is there still generally a big bid-ask spread? Are sellers still just as stuck on 2021 pricing?
Yeah, wow, that's a really good question. So the gap is narrowing. That is good news. We have an LOI right now out on a deal. I don't know if we'll get it. We're going to certainly try. We love the deal. We love the location. We love the property. We love everything about it. It's going to be a price issue. But the gap is starting to narrow. It is. So that is good news. We are seeing more deals hit the market. A lot of what's hitting the market right now is A-class stuff, because the builders, like they always do, they go crazy and they build. Well, it takes them 2 or 3 years usually to get this whole thing, from start to finish. All that stuff's coming on the market now. So most of what's coming on right now are builders selling Class A stuff. We're getting there. It's moving. Deal flow is increasing. I think, I'm optimistic that we're going to be able to nail something down here soon. Hopefully that helps. Let me know, Max, if there's a follow-up to that. Okay. Seems like the debt ceiling issue is going to be resolved. Obviously I don't have a crystal ball, but it does seem like both sides want to get this behind them. They don't want to, neither party wants to be the one to cause some sort of default. So that is certainly a good thing. Interest rate, well, I already talked about this. Interest rates were settling down until the last 5 to 7 days. I would really appreciate it if they would settle back down again. It just makes it a big challenge. The Fed does seem to continue to get help reducing demand from the banks tightening credit. That's good. So that's, the Fed, what happens is when the Fed raises rates, people can afford to borrow less, right? Because they can't pay the interest expense. Well, when the banks also tighten their credit standards and lend less, that makes that sort of helps the Fed accomplish its goal, because that reduces demand. So that continues to happen. I do think there's a lot of people that believe that the credit markets are going to tighten more as office and some of the other loans become due. Remember, there's a lot, we'll talk about this in a minute, but a lot of those loans are on variable rates with rate cap protection. And as those things start to expire, we're just, I think that you're going to see some credit market tightening. I do think that the office space is going to be the next shoe to drop. There's going to, look, I'm not an alarmist. I'm not an extremist, never have been. I don't think it's going to completely destroy the world, but there are going to be some real losses on the bank's books from some of these, a few of these multifamily loans that can't get refinanced because they don't have enough new cash flow to absorb the interest expense. But I think the office space, the office loans are going to cause a far bigger problem than multifamily. Again, I don't think this is a 2008 thing by any stretch, but I do think there are going to be some losses that are going to be realized. So, you know, we always talk about this credit markets tighten thing, right? And I have this conversation with a lot of people, and I thought, you know what, I just spend a minute here and talk about what that means, because a lot of people don't really know what that means. You know, we say it all the time. Well, the credit markets have tightened up. Well, what does that really mean? Basically, what it really means is that for some reason, in some way, credit is harder to get. So in some cases, the lenders just stop lending. A great example of that is Fannie and Freddie. We do a lot of, you know, the multifamily world does a lot of loans with Fannie and Freddie. And when they meet their quota, they literally close their door and stop talking to you. They're not going to lend any more money. So that is an example of credit markets tightening, because when Fannie and Freddie are out of the market, there's far fewer places to go for a loan. Right now, Fannie and Freddie are the primary lending sources in the multifamily world. The bridge lenders are still there. It's just the rates are so high, nobody can make anything work. And so hopefully Freddie and Fannie has still quite a bit left in their quota. Now, the other reason that banks tighten, well, they get uncomfortable with their ability to manage the risks. So they have this uncertainty. Nobody likes uncertainty if you're lending money or doing things like that. So when they start to lose visibility, or I should say confidence in their ability to understand what's going to happen next, they start to tighten. They start to increase their credit standards. They make their debt service requirements, their coverage ratios. DSCR is debt service coverage ratio. They make those ratios higher. So maybe in normal times, I could get a loan at 120, or somebody could get a loan with 120% loan coverage, meaning NOI has to be at least 120% of your debt service. But maybe when they get stressed out, they say, you know what, we don't know what's going to happen next, so we're not going to let you get a loan in that tight of a condition. They're going to want you to have 140% instead of 120. So that's tightening. That means you can borrow less. They're also just looking at loan to values, right? So if you have an appraiser go out and he says the property is worth X, they may say, you know what, we used to go to 80%. We're not going to 80% now. We're just not comfortable with that. You know, they'll go down to 70 or 65. We generally find most lenders right now are in the 65% range. That seems to be the sweet spot right now where it works out. And finally, credit is still available. This is more just thinking about what it means when credit markets tighten. You will hear people say that spreads widen, and I want to spend just a second to explain what that means, because it's real. So let's say you're looking at a Freddie or a Fannie loan, and all of a sudden rates drop, and everybody runs to Freddie and Fannie, and they want to do their loan right away, immediately, because rates are down, and they want to get a good loan. Well, when they get overwhelmed with demand, they literally widen their spreads. That means whatever maybe they were charging 180 basis points over the treasury. In order to slow down that demand, they'll actually raise their spread and say, no, we want 200, 210, 220, whatever the number is. The point is that they make it more expensive. So as rates come down, if demand is so crazy that Fannie and Freddie can't handle the volume, they'll just increase their profit margin on the loans. So it's as if loans and rates never came down, and then people slow down, right? That's how they control their volume. And then of course, credit does tighten when the indexes rise, right? That's what the Federal Reserve did. In a 1-year period, they went from 0.08% Fed funds rate to 5%. I mean, that's just crazy. So that caused all of our indexes, the Treasury indexes, to rise, the SOFR indexes, and everything else. So that's a little bit about what credit markets what it means when we say credit markets tighten. It's real. It's a real thing. And it's kind of aggravating if you're a borrower trying to nail down your loan terms, because you look and you see treasuries go down and you're like, sweet, this is my chance. And then you call your lender only to find out, yeah, well, guess what, the lender increases spread, so you're basically no better off. It's kind of frustrating, but that's just how the system works. Any questions on that, Max?
Nope, no questions.
Cool. All right, let's get back to tonight's headlines. Has the market bottomed out? Here's what I think. Generally it's area specific. I will tell you that market demand and supply issues are becoming much more important when you have rates that are up like they are right now. I'll give you an example. We're in Florida. We love Florida. The reason I love Florida is because the demand supply imbalance is so ridiculous that it allows me, a lot of bad things have to happen in order for that demand to get destroyed so much that now we don't have more demand than we do supply. So if instead you're in a market like Warren's on this call, I don't know if he's still on the call, but if he is, Warren's in Phoenix, and Warren is watching Phoenix's market expand with brand new supply. They built like crazy. They're adding, I don't know, 20, 30,000 units. I think Nashville might be the same thing. John's on this call. He knows that. And so now you have demand supply issues. So has the market bottomed out in those metros? Maybe not, right? If you're looking at Cleveland, well, Cleveland's very sensitive to demand supply. You have a little bit of drop off in demand, and it's going to really affect the real estate market. It's also going to depend on how bad the oncoming recession will be. Most people think that we're going to have a recession sometime in mid 2024. Most people think it will be relatively mild. And in fact, they think it's going to be even milder than previously thought. That's part of the reason rates are ticking back up a little bit. It'll also depend on how tight the credit markets get. If the office loans come in and the banks start, and they start to get a lot of losses, the banks start to feel that pain. They're going to tighten up their lending standards in a significant way. And if they do that, that will just put more downward pressure on price when people are trying to sell their properties. And then finally, this little thing's been percolating in the background for, well, at least a year now, and that is have people with these expiring rate caps fix their problems. So they're still 12 to 24 months out on most of these rate cap expirations. Hopefully they will have taken advantage or done whatever they got to do to shore this up. But if not, if they haven't, and we have significant rate cap expirations and properties unable to make that new debt service, that could impact the market. So I think generally in Florida, we're pretty close to the bottom. I've never tried to call tops and bottoms in this business. I can't. It's just too hard. If you just stay disciplined, you can pretty much do okay in most markets, up or down markets. All right, hold on here. There we go. All right, what about the banking crisis? I think I talked enough about this. Office loans still have me a little bit worried. Again, I'm not freaking out or anything like that. I'm not an alarmist, but I do think they're going to create some pressure on the banks. We do still also have some multifamily deals that are still going to also add to losses. The banks are still carrying those unrealized losses. At some point, they're going to have to write those down or do something with those, unless rates are going to return to super low levels. I don't see that happening. So at some point, the banks are going to have to realize those write-offs or else hold them to maturity. And, if they put a 10-year security, that's a long hold. So we'll see how that shakes out. I don't think we're going to see a big banking crisis at all. I think the number one thing that stopped anybody from caring about bank failures is when the FDIC came in basically and insured depositors at 100%. They haven't. That's not a legal thing that they did. They just basically sent the message, no depositor is going to lose their money in these banks. So if no depositor is going to lose their money, nobody cares, right? Except the people that own the banks. So I think that was critical to shoring up this bank crisis as fast as they did. And I think that'll continue to be critical. I'll be curious to see, though, what happens when these losses start to hit the bank balance sheets. When these loans start to struggle a little bit, especially the office side. So time will tell on that. All right, what's the Fed's next move? I don't have a clue. I think they're close to done. I do know they need to continue to see reduction in the consumer price index and the other metrics they're watching. They need to see that labor market begin to struggle. Most people think that they've done enough. It is no secret that the Fed has a habit of overcorrecting. They just always have. They're pretty smart people, so I'm sure it was on purpose. I'm not going to pretend that I know more than they do. But if you look back over time, they've generally been late to start and slow to stop, whatever it is that they're trying to do to affect the economy. It would not surprise me if we saw another 25 basis point increase. I think that most economists would say it's not necessary, but right now I think the market's starting to think that it might actually happen. Should you invest now? I have no change in my position from last month, and it's not because we're in this business. I just know that I think right now is a great time to invest. I don't think that cap rates are going to go much higher. I think we might actually get some cap rate compression over the next 5+ years. I am not underwriting that into our deals. In fact, I assume the opposite. So if I get some cap rate compression, that means cap rates go down. That means values go up just because rates, start to ease up. That's just icing on the cake, so to speak. The insurance problem, I think that is going to get under control. I think right now it's really, really important that you continue to follow my vetting rules that I always talk about. Stay super disciplined when you're underwriting, and whatever you do, don't reach. Don't get FOMO. Just you got to be patient. I know the folks that are committed to our second fund. You have been incredibly patient. I can't be more thrilled that you are. Just remember, it's my job to make you money. To do my best to do that, not to just deploy your capital in any deal and then hope and pray that we might make money. That's just not how I operate. All right, what's really going on out there? So we already talked about some sponsors still have variable rate loans, and it's eating up all their cash. Many of them are still having lenders require escrow so that they have enough money to buy new rate caps. When the time comes, that is destroying their cash flow, their distributable cash flow to their investors. Some of the sponsors even can't pay their debt service, and they're doing cash calls. And hopefully nobody on this call is having that situation with an investment that you're making. We continue to have great rate protection. Our markets are super strong. We do not have any intention right now to discontinue distribution. So we plan to absolutely continue. All of our properties operationally, they are still at 93% or higher. Right now, the Daytona market seems to be the softest. It's one of the reasons I really like townhomes, because they always do well in almost any market. But Daytona seems to be the softest, and it's mostly about credit quality there. Not about people, it's just about quality. Delinquencies continue to be low. Rents do remain strong. There's still no significant retracement so far. We have a couple clients that have bumped down their rents for different reasons. It's not a market-driven thing. It happens to be a property-driven thing. As I said earlier, our leasing traffic is still insane. It's very, very strong. There are no shortage of people moving to Florida still. These are real metrics. I looked these up yesterday. I just wanted to make sure that I give you the real stuff. In April, our portfolio. Now think about this. This is our owned portfolio. It's the deals that I actually control. Our new leases. So if somebody moves out and we move a new person in, those new leases, the rents are up 27.1%. That's just crazy good. That's awesome. I love that. If you live there and we give you a renewal, on average, we're getting a 12.5% increase on that. So what that tells you is the market continues to be very strong. I also want to remind you that the fact that we're able to do that is not indicative that the whole market is doing that. That is not what's happening. What's happening is we have a value add business plan. So we make our properties more valuable. Because of that, we make them nicer. We make them much better than they were before we bought them. And because of that, we're able to command higher rents. That coupled with the demand supply imbalance is the reason we're able to get such really, really nice rent increases on renewals as well as new leases. Still no concessions in place. Now, this next little fact here is why I think the insurance market might be starting to turn. It's a process. It doesn't happen overnight. But I would remind you, I've reported this previously, we did get a 6-month property extension on our Bradenton deal, and it was flat, no increase. So that was certainly good news. That got us through the hurricane season. And by the way, that property did, survive a hurricane. I mean, that thing is built so tough, it's unbelievable. There was nothing. It survived just fine, did very, very well. We had a 19% increase in Daytona on that deal on our insurance. You think, wow, that's a lot. Yeah, trust me, some people are getting doubles. So we're super excited about that. And then this just blew my mind. We just had our general liability, our GL renew and our Winter Haven deal. And it went from 19.3 a year down to 9,800. I mean, that nobody's getting decreases in this market. That property is just an awesome property. We just put new roofs on it. And I think, our guy just found another carrier that really wants to write deals in the middle of the state and newer stuff. That's a 2001 deal. So that is the evidence that I used to tell you that I think we might be starting to turn the market. The other reason is, Warren Buffett was on CNBC recently, and we know Warren Buffett might own an insurance company or two. But his comment was that, the pricing in Florida is, starting to be attractive. And that's what happens. That's what we need insurance companies to see, because when that happens, they then decide, hey, I can get in this market now and be profitable. And then they'll all come back. It's the craziest thing to watch, but I think that's about to start happening. And hopefully over the next 12 to 24 months, we start to get some relief there. Debt, we are being proactive, and I am certain it will pay off nicely. I'm going to have a lot more to announce on this next month. I really can't talk about it yet. I don't talk about things until they actually happen, but just suffice it to say that I think if you're in our fund and you're in our deals, I think you're going to be pleased with what I talk about next month. I'm not trying to tease you. I'm not doing that. I want you to know that we are in a very, very good place with our debt, and we continue to be well protected. Very important to me. All right, what do you take from all this? Do your homework before you buy. Underwriting really, really matters. I'll just mention as a side note, we have been working for the last, 6 months max, maybe something like that, on fine tuning our underwriting course, and we're rolling that out here soon. So if you're somebody who wants to really understand how underwriting works, it's a course is probably, 15, 20 hours of instruction and our spreadsheets and everything else. If you're interested, reach out to Max. Operations matter. Don't ever let anybody tell you operations don't matter in this business, because it does. Investing with experienced firms continues to be really important. And, I want to be careful here. Yeah, I'm thrilled that we're doing so well, but it's because of our investment thesis. And it's because we stay super disciplined on that. See, just to remind you, we buy apartment buildings in growing areas. That's extremely important that it be in growing area, in good neighborhoods, good, again, extremely important, with some physical improvements and management expertise can be made to be much more valuable than they are today. Those physical improvements or management improvements allow us to raise rents, just like what you saw me report earlier. We're able to rent to better quality residents, and the whole thing allows us to significantly improve the cash flow of the asset. And, when you continue to improve the tenant quality, when new people come to the property, they see even greater quality tenants, then they want to move. And the whole, it sort of feeds on itself. So this business plan is what I've done my whole life, and we're not going to stray from this anytime soon, because this works. This business plan got people through 500% rate increases are crazy. We should be in trouble, but we're not. All right, our fund terms, I'll just throw that up there. I'm not going to read through them, one by one. Just know that the way this happens, I'm only sharing this because this is what really happens, and Max will attest to it because he sees it. We're underwriting deal after deal after deal, and we're just getting frustrated. And all of a sudden, boom, there's the deal. It seems like when you're the most frustrated, the deal that is going to be the right one lands in your lap. And that's what we're trying to go after right now. So just, do me a favor, make your commitment to the fund. You don't have to send me a check. You stay invested in whatever you're invested in until we call the capital, but you're in then, right? Because when it happens very fast. If I get the call that our LOI is in the hunt, we'll try to lock it down by early next week. That's how fast these deals tend to move, because brokers, that's just what they do here. You know how to get started. Just reach out to us, right? Call us, hit the QR code, reach out to Max or myself. And we'll get you what you need. Make sure that we get you all the information that you need should you be interested in the fund. I have talked nonstop. Anybody have any questions whatsoever?
There's one question in the chat. It asks, do you have in-house property management?
Yeah, absolutely. Yes, sir. Or ma'am, who asked the question?
It was Allie.
Okay, Allie, yes, absolutely we do. We're vertically integrated. Back in 1998, I went out on a limb. I thought I was still at Deloitte, right? So I was working a lot, and I thought, you know, man, this would be great if I could get a third-party manager to do all the real work. I hired them, and 30 days later, I got rid of them. I mean, I'm laughing, but I can't get anybody to react with the same level of urgency that we have. And you know, now fast forward 25 years, I mean, we are hyper focused on becoming as efficient as we can. We use technology to make sure that we reduce our labor requirements. Give you an example, the typical staffing model require, you know, the traditional model is one person in the office, excuse me, for every 100 units. Well, I'm on a mission to change that metric to be one every 200 units. And I'm using technology and various other things to do that. One of the biggest challenges in our business is labor. It's probably in every business. So if I can whack that number in half, just think about that all that money goes right to the bottom line. So yeah, we manage our own stuff, and that's probably the way it'll always be. So great question. I'm glad you asked. All right. Well, I see a lot of very familiar faces here. If I can't tell, I can't scan quickly enough. I do see some investors here. I see some non-investors. If you're an investor in our fund, if you have any questions about any of the deals, you're welcome to raise your hand. Hey, wait, we got Jerry. Jerry's here. What's up, Jerry? I see your hand raised. Sorry about that, my friend.
Hi, good evening.
Good evening, sir.
What the heck is first right of refusal on side raises?
That is a really good question. Man, you always got the good ones. I love having you. Got to come to all these, would you?
No.
So the Bradenton deal came along. It was a $41.5 million deal. And I had raised the fund. It was like 12.6 or 12.5. I don't remember. $12.5 million. The fund was closed. Because once we do that first deal in the fund, nobody else was allowed in that fund. But I wanted to do that deal in Bradenton, so I needed more equity. So if you're in the fund, I go to you first. I don't go to anybody outside. I go to you first. Hey, this is the deal. Now you get to see all the numbers and all that stuff. Do you want to invest additional monies? And it'll only be in that deal. That's a side raise. That's what they call it. And Ben will know exactly what I'm talking about. Those people took like 80% of that deal. And then we had 20% that, you know, we always have people that want in our deals. So we filled it with the rest with outside people. And I know some people.
So if you had a fund that had Bradenton, Daytona, and another property, this would only apply to the Bradenton?
Yeah. So you would do a side raise if you need more money than what's already available to you in the fund. Right? You don't want to turn the deal away because it's a great deal. So you want to fund it somehow.
Pardon my ignorance, but LOI, I take it's making an offer on a property, but what is LOI?
Yeah, letter of intent. That's a really good question.
Letter of intent, okay.
Yeah, it's a non-binding. They're generally not non-binding, but what you do is you lay out the terms which you would buy the property.
Right.
Lawrence, what you got, my friend?
Yes, Ken, I apologize if you already answered this, but is the current fund, this fund that we're raising money for, is it full? And
No.
If not, how full is it?
So here's the nice thing about funds. The nice thing about funds is you continue to fundraise until you find that first deal. The moment I find that first deal, here's what happens. I give everybody a heads up. Hey, heads up, we got it. I'm pretty sure this is going to be the first deal in the fund. And I will say to people who are already committed, if you want to change your commitment, if you want to increase your commitment, you've got to do it now. I tell the rest of the people out in the world, if you've been waiting and you're not sure, you've got to make your decision now if you want to get in that fund, because about a week to 10 days later, we will do our first capital call. So what happens then is I know exactly who's in the fund and exactly how much they have committed. And then that allows me, I know how much capital I need for the first deal. and I just do the division, say, okay, Lawrence, you send me this, and Jerry, you send me that, and Max, you send me this. And then once I make that capital call and everybody starts sending in their cash, everybody's percentages are fixed. So I don't let new people come into that fund and further dilute you. I don't do that. I don't want to do that. So the point is the fund isn't closed. The fund can't, the lawyers put $50 million. I don't want a $50 million fund. That's way too big. I just can't deploy that capital that quickly. I'm having a hard enough time deploying what we have. So the fund will be somewhere between, probably between 10 and $15 million is where I would like it to be. The last one turned out with the side rate to be at 16 and a half. So we can continue to raise until I do that first capital call, and then we shut it down. So then if you want to do another deal with us after we shut that down, you can either come in through a side raise, or you have to just, make your commitment to the next fund.
Okay.
Does that make sense?
Yeah, and will you, on the fund, will you add projects to the fund? Like, how many projects will you add to it?
Till I
Like, if
deploy
you
all the
put out
capital.
one building, will you add a few more buildings in the fund?
Yeah, so let's look at what I did in the last fund. The first deal, what was the first deal? Tallahassee. So we bought that deal, closed it. That was our first capital call. That shut down the fund. Nobody knew was allowed to get in that fund after that. So then we found the next deal. That was that small deal in Daytona. And okay, so now we did our second capital call. And then I might have this out of order now. I can't remember. They were very close to each other. And then the Bradenton deal came, and I said, oh, wow, we need to do this. This is the final capital call for the fund. And by the way, we need more. That's how it goes. So my goal is to deploy that capital as quickly as I can, being disciplined. The commitment period. So once you send in that first capital call, once you do that first capital call, under the documents, have 18 months to deploy the rest of the capital. If I don't, you're free, right? You're no longer obligated. But obviously 18, most funds do 3 to 5 years for commitment periods. That's too long. I can't get comfortable with that. I don't want to hold your money hostage for 5 years and not, do anything with it. That's not cool. So 18 months, and it's I think we closed our first deal in Fund 1 in maybe November 1st, and the last deal June 15th or 20th or something like that of the following year. So it took us about 8 months to deploy it all.
Oh, so the fund continues to buy until all the capital is actually spent.
Yes, sir.
And then you start a new fund.
Basically, yes.
Okay. All right. That's
Yep. We just keep doing the same thing over and over. Yeah. So one of the benefits of having that fund, Lawrence, let's say you have 3 deals in the fund and one of them wasn't doing so well, but the other 2 were doing really well. Well, they can kind of support, right? So now you're getting some diversification. Think of Fund 1 investors. They're in Tallahassee, Daytona, and Bradenton. I mean, those are massively different markets, and they're different building types. I mean, it's as diversified as I can figure out how to make it in multifamily, right? It's just a great diversification. So you get that benefit. We didn't have to do multiple sets of documents to deploy all that capital because we only raised the money one time. There's just a lot of benefits to that.
got it. Thank you.
Good questions. Who else? Are we going to get Jerry back?
Sure.
All right. What's up, sir?
Accredited investor verification.
Yes.
So I'm in a bunch of multifamily investments. I've got to ask the manager to estimate the net value, estimated net value of all the assets to satisfy that.
Well, let's talk about how we do accredited investors. So by the way, these are SEC rules. These are not my rules. The
Sure.
SEC requires it. So that's first thing. There's 2 ways. I'm going to do the most common. You would qualify based on your income. So if you make $200,000 a year for the last 2 years, expect to do the same this year, or 300 if you're with a spouse. Or your net worth, so assets minus liabilities, not counting your home, has to be more than $1 million. And somehow you need to be able to verify that. Now, income is the easiest. So what we prefer is we give you a form letter, your CPA, who presumably knows you and knows what you got and what you don't got. They know what your situation is. They will fill out the form, the letter. They'll just say, yes, I know Jerry's accredited, it's income, here's why, I've looked at his tax returns, or whatever it is that he or she knows that you meet that definition. They sign the letter, they send it to me, because I really don't want to see your personal stuff. That's the most common thing. You can do it with an attorney as well. You can do it with certain broker dealers, right? If they have certain licenses, you can do that. Now, alternatively, a lot of people there's online services like Verify Investor. So it's like 79 or 59 bucks. I don't know. It's not expensive, but you go to them and you say, look, I need you to verify that I'm accredited. They ask you for a few pieces of data, and literally within a day or two, they send you back the letter. You send me the letter, we're golden. And so the reason I need the paperwork in my file is but when the SEC audits my files, they need to see that everybody is accredited and I have proof of that. I've done something to make sure that that's happened. Now, if neither of those two appeal to you, we can do it ourselves. So we can look at your last 2 tax returns and see if you income qualify. We can look at all your assets. This is SEC stuff. This stuff is ridiculous,
Right.
but
I'm asking because as a long retired person, it's not about income, it's about my investments.
yeah, and that's, Jerry, you're not the only one. That's very, very common. So, I recommend you choose the easiest route to do that. If you're in other investments, I mean, if they're doing a 506c, they're following the same rules.
Right.
Now the good news is, when you reinvest, I don't have to verify again. It used to be I had to verify again. It was just ridiculous. But now we get 5 years. We get 5 years of we'll believe you that he was accredited for the next 5 years, and then he might have to prove it again. I would love for those rules to change. They are evolving, Jerry. I will tell you that. I can't promise you that what's going to happen, but
I don't see a problem. I just thought I'd raise it for some others here, and I'll be in touch on the actual letters.
yeah, absolutely. So Sherry or Max can send you a sample Word document, because what I don't want to do is have your CPA charge you a lot of money, because I know that I'm a CPA. I know what they do. We'll give you the sample Word documents. All they need to do is change the name, and it's good to go. So we're here. I want to make it as easy for you as I can.
Okay.
All right, Quinn, what you got, sir?
Hey, good evening. Sorry, I showed up a little bit late to the show here, so I'm sure that my question has been asked, but I'm going to ask it anyway. So it's the first time that I've pulled into your team, So
well, welcome. I'm glad you're here.
Yeah, you bet. Thank you very much for putting this on. So accredited investor, no problem there. I have one. I have my letter from my CPA and all that jazz. Do you have a minimum investment for your funds?
Yeah, we have a minimum commitment to 100,000.
Okay.
That you're not gonna. So remember, when you subscribe, you're making a commitment. You're not writing me a check. Stay invested in whatever you're invested in until I find that first deal, and we call that capital.
Yeah,
So
that's what I gathered.
Fund.
Yep, I got that. Okay, cool. Sounds good. And then it was kind of asked a little bit earlier, but maybe not answered exactly. When do we have, or when do you have any anticipation on when this particular fund will be closing?
Well, it's when we find that first deal.
Oh, when you find, maybe it was.
Yeah, and okay, Quinn, I wish it was 3 months ago. Okay.
Yeah.
Here's what, and I'm going to say this out loud. I know you know what I'm going to say next, guys. Please be patient with me. I am extremely disciplined. I'm going to do everything I can to make sure we do a good deal. I could have closed this fund 6-8 months ago easily, all day long, because there's deals out there, but I'm just not going to do one that I don't like. Right. I've been doing this for a really long time, and I want to make sure we make a killing, just because. And you know what? Have you seen our stuff yet? Have you gotten access to our stuff yet?
No, I have not.
Okay. So Max, if you could get his, maybe in the chat or something, his email address, and we'll shoot you out a link to the page, right? So that you can see the PPM and all that stuff. It sounds like you've done this before. So you might, I want to get you access to the information you need to see.
Okay. Sounds good.
All right. Anything else? Anyone else got any questions for me?
There's one more in the chat. The question is, do investors receive depreciation losses from the property?
Oh, that's a really good question, and I'm surprised Jerry didn't answer. He probably already asked it earlier last week, maybe. So, yes, the answer is yes. So what they're talking about is you get depreciation in real estate. And that's important because you're actually getting to take a tax deduction against an asset that's actually going up in value. It's the craziest thing, but it's one of the few benefits that the IRS still has. And it's a big deal. So usually when you invest in our fund, you're going to get a K1. That K1 is almost always going to have a tax loss on it, unless we've held it for quite some time and we've moved rent so much that we've offset all the depreciation. So that means that while you're getting these cash flow distributions, you're not paying tax at the time that you're getting that cash, because the depreciation deductions are sort of protecting that, so to speak. So some sponsors will have some goofy special allocation that gives them back, gives those depreciation deductions back to themselves. We don't do that. If I have 5% of the fund, my capital is 5% of the fund, I get 5% of the depreciation. And just like you would if you're 5% of the fund. So no, that is a really good question. I'm glad you asked it, because it's super important, because a lot of people don't pay attention to that, and they get their K1 thinking they're going to get this big deduction, and they don't, and they're disappointed. I think last year, now the rules have changed a little bit, because we do cost segregation studies on our assets. It was something like 85%. So if you made $100,000 investment, you got about an $85,000 deduction. And I'm rounding. I don't remember the exact numbers now. But it's through cost segregation and things like that. So, yep, it's a big deal. This year, that special rule went from 100% down to 80%. Still good, but here's the message that I want to leave you with. I would recommend, taxes are important, but I have to make sure the deal makes sense economically, and then your little tax benefit, that's just icing. All right, I don't factor that in to whether or not we're going to make a deal or not. I just know that it's there. I'm doing it because we economically, cash in, cash out, we have to make money. And I should show you how many, are there a lot of new people? I get a lot of new people. I always get concerned, because I don't want to do a lot of repeat material here, but if you will allow me to do this, I just want to show you the last 3 deals that we turned. That you might find interesting. So this is a deal we did in Clearwater. We bought it for just under $6 million. And by the way, if you get our information, you're going to get access to the track record. You're going to see all this stuff. But this is a Coachman. We bought it in Clearwater. We sold it 2.5 years later for $8.2 million. Here's what's important. Our investor annual return was 30%. So that means that if you gave us 100 in 2.5 years, you got a total of 175 back. That's over a 2.5 year period. Bell Reef Club Apartments. Now, this YouTube video, this is one of the YouTube videos that we have there that kind of really walks you through what we do, how we do it, why we do it. This is a lot of before and afters. This pool did not look this nice when we started, trust me. So this is 100 units in Jacksonville, 104. We bought it for 7.5, sold it 3.5 years later for a little over 13. We always move rents. All of our business plan always involve moving rent. So in this deal, we moved it from 750 to 9.25, which gave our investors a 22% annualized ROI. So that means you gave us 100, you got back 177. And these are full cycle deals. So these really did happen. This one we sold coming out of the pandemic. I think it was February. This one we sold a little bit later, like a month or 2 later, something like that. You can see I love townhomes. We bought this little deal in Orange City, Florida, just off I-4. Nobody has any clue where Orange City is. It's a little dinky town, but boy, it's growing like crazy because it's so close to I-4. $5 million, we bought it, sold it literally 2 years and a month later for $8 million. Moved rents from 700 to 850. Ridiculous returns here, 36% annual returns. Our investors, if they put in 100, they got back 172. So these are the kind of deals we do. So I don't know if that's helpful. Hopefully it is. A lot of people have seen this presentation repeatedly, so I try to be respectful of that. But I see so many new people here. I wanted to make sure that you had an opportunity to see those. Those are real deals that we did them with investors, and those, I mean, they're done, they're closed. You can't argue with the returns. They actually did happen. So. All right, any others? Yes, sir. Nancy, you're not Nancy, but
Yeah.
that's okay. I can.
So
I know you're not.
yeah, that's Rob. I couldn't get mine to work. You know, she's techie. So
No worries, no worries.
so in order to take advantage of the K1, can you do that as a passive investor, or do you have to be considered a professional real estate investor? Or
Yeah, that's a great question. So that I have to leave the answer to that question to your accountant, because there's a lot of things that go into that decision. It really depends on you. I know there used to be somewhat of an exemption. I have been active for so long, I don't even follow those rules anymore. But here's what's important. If you are not able to take the losses, if you're not, right, they actually get suspended and they get carried forward. You track them so that when income comes in, that's what, you're not paying tax because you have these losses to offset it. The other thing that's important is, even if that K1, you couldn't take the loss, you're still getting cash and you're not paying tax on that cash. Very important, right? This is it.
Yeah.
Now it's not a permanent, you don't get it for free forever, but you don't pay tax on it at the time that you get it. So check with your CPA on that, because there's a lot of rules there, but a lot more people qualify than you probably would realize. And where you're at in that risk continuum is going to depend on your situation. So it's a really good question.
thanks.
You bet. Yes, sir. Mr. Quinn, are you still up, or are you new?
No, I got another question.
Oh, good. Okay. Yes, sir.
Yeah. So it seems like you, on those three that you showed, the last three, seems like you're selling. I mean, like you buy and then you sell, like within a reasonable time frame, and which is maybe a little different than some of other folks that are more of a buy and hold.
Yeah. So let's talk about that. So we're a value add investment firm, right? The thesis that we're using right now is value add. Let me tell you why I do it this way. Number one, I have learned over the years that people really like to go into an investment, make money, get out of that investment, and get to make that decision again. Do I want to go back in? Is my life still okay? Do I need this money? What a lot of people do is they take a little bit and they go splurge. I got some stories that, one of our investors used one deal to buy his son a house. Another guy took one deal and he took his family on a European first-class cruise, but then he invested the rest. So I know that I watch people and how they act. They like to have that ability. Now, most people, our reinvestment rate is probably well over 90%. I haven't calculated it lately, but people do reinvest with it. If you're going to deliver 20-30% returns, who's not going to keep doing it, right? So, but you have that choice. That's what's important. That's what I think people like. Now, we can hold longer. It's just, I want to be careful now, because if I'm telling you, see, we're going into this relationship, Quinn, with a set of facts, right? I told you what I'm going to do, and it's important that I keep my promise, right? I don't want to get you in and then stretch you out and say, oh, yeah, just kidding, we're going to hold this thing for 12 years, right? That's just not fair, right? It's just not what we do. So I think about value add. Think about if you go in and renovate your kitchen, is it going to last 10 or 15 years? After about 7 or 8 years, they get that itch. You want to do it. Well, the same thing happens in the real estate world. Things get tired. And if I hold too long and I don't have new capital to invest back in the asset, now I got a problem. Because now I ran it back down and I don't have any new capital. See, in syndications and funds, I don't call you and say, hey, Quinn, guess what? It's been 7 or 8 years. We want to go do some more kitchens. Can you send me some more money? That's not going to be a friendly conversation. You're not going to want to get that phone call. So that's why we like that business plan. There's a lot of reasons why. You bet.
Yeah, no, that makes sense.
Jerry, yes, sir.
Do
You
those
had the depreciation question, aren't you?
do those loss carry forwards apply to capital gains when it's sold, when the building is sold?
I believe they do. You should confirm that with your CPA, but I believe they do. Check how that works, Jerry. I don't want to be your final source for that one. Okay. I just don't. Here's what's really important. Capital gains. You know what the rate is for capital gains? I think it's about half of the ordinary income rate.
Yeah, it's about 15.
Yeah,
What-
it's about half, I think. Yeah, 15 to 20. But think about that, all right? Imagine you kind of traded ordinary losses for capital gains. That's not bad, right?
I've been there.
I'm sure you have. All right, any other questions, guys? You guys have been awesome. This is a lot of fun. I really enjoy having these conversations. We are also going to start doing what I call a private wealth seminar. It is for somebody who is much more beginner, right? It's going to kind of start from the beginning. How do you make money in real estate? What are the benefits? You know, it's going to be more beginner focused. So, you know, you'll get on our list and you'll know about it. You know, it's a different type of webinar. So if you want and you're interested, you know, make sure you sign up for that, but just be on the lookout for it. All right. Well, guys, thank you again. You have a wonderful evening.